Hold on tight because the stock market is on a wild ride today. The volatility we're witnessing is nothing short of extraordinary, with traders and investors alike scrambling to make sense of the rapid shifts. It's a day that will be remembered for its dramatic swings and unexpected turns. After yesterday's incredible surge, the major indices are experiencing a significant downturn. This sudden change has caught many off guard, leading to a flurry of activity on trading floors and in financial newsrooms. Analysts are working overtime to understand the underlying causes of this abrupt shift. Dow futures have plummeted by a staggering 638 points, a decline of 1.3%. This drop is sending shockwaves through the market as investors reassess their positions and strategies. The Dow's performance is often seen as a barometer of overall market health, making this decline particularly concerning. The S&P 500 futures are also feeling the heat, down 1.9% or 116 points. This broad index, which represents a wide swath of the market, is reflecting widespread investor anxiety. The decline in the S&P 500 is a clear signal that the market's troubles are not confined to a single sector. Tech-heavy Nasdaq futures are taking the biggest hit, down a considerable 2.4% or 509.25 points. The technology sector, which has been a driving force behind recent market gains, is now facing significant headwinds. This sharp decline is causing many to question the sustainability of the tech rally. This sudden reversal of fortune has left many investors bewildered and searching for answers. The rapid changes are creating a sense of uncertainty and unease as people try to navigate the turbulent market conditions. It's a challenging time for anyone with a stake in the market. The markets are clearly reacting to a confluence of factors. From economic data to geopolitical events, there are multiple influences at play. Financial analysts are dissecting every piece of information to provide insights and guidance, but the complexity of the situation makes it difficult to pinpoint a single cause. Investors are grappling with the implications of President Trump's latest trade moves. His policies and statements are having a profound impact on market sentiment, adding another layer of complexity to an already volatile situation. The uncertainty surrounding trade negotiations is contributing to the market's instability. The economic data released today paints a mixed picture, leaving room for both optimism and concern. While some indicators suggest strength, others point to potential weaknesses. This mixed bag of data is making it difficult for investors to form a clear outlook, adding to the overall sense of confusion. And as always, geopolitical tensions continue to cast a shadow over the global economy. From trade disputes to political unrest, these factors are creating an unpredictable environment. Investors are keeping a close eye on developments around the world, knowing that any significant event could further disrupt the markets. Yesterday's market performance was one for the history books. The S&P 500 soared by an astounding 9.5%, marking its best day since 2008. The tech-heavy Nasdaq Composite wasn't far behind, surging by an impressive 12%. Even the Dow Jones Industrial Average joined the party, surging by more than 7.8% or a whopping 3,000 points. This remarkable rally was fueled by a surge in optimism after President Trump announced a 90-day pause on reciprocal tariffs for most countries. Big tech was among the biggest winners, with Nvidia, Tesla, Apple, Meta, and Amazon all posting double-digit gains. Chip stocks also got a boost, with Nvidia, Broadcom, AMD, Intel, and ARM all experiencing significant gains. President Trump's decision to pause tariffs on most countries, except for China, has injected a dose of uncertainty into the markets. This move has left investors and businesses in a state of limbo, unsure of what the future holds. The initial reaction was mixed, with some seeing it as a temporary relief, while others feared it might be the calm before the storm. While the pause has been welcomed by many as a sign that trade tensions might be easing, there is still a lingering sense of caution. Business leaders are cautiously optimistic, hoping that this pause will lead to more stable trade relations in the future. However, the uncertainty remains palpable. The increased tariffs on Chinese imports have added fuel to the fire. These tariffs have not only affected the prices of goods, but have also strained the relationship between the two economic giants. The ripple effects are being felt across various sectors, from manufacturing to technology. The US has raised tariffs on Chinese imports to a hefty 125%, a move that has been met with significant backlash. This substantial increase is aimed at pressuring China to make concessions, but it has also led to higher costs for American businesses and consumers, prompting China to retaliate with 84% tariffs on US goods. This tit-for-tat escalation has created a challenging environment for companies that rely on international trade. Many are now scrambling to find alternative suppliers or markets to mitigate the impact. The markets are now trying to digest the potential ramifications of this trade war. Analysts are busy crunching numbers, trying to predict the long-term effects on the global economy. Investors are closely monitoring the situation, ready to react to any new developments. On the one hand, the tariff pause could provide some breathing room for businesses and consumers. It offers a temporary respite from the escalating costs and uncertainties that have plagued the market in recent months. On the other hand, the escalating tensions between the world's two largest economies could have far-reaching consequences for global growth. The international community is watching closely, as the outcome of this trade dispute could reshape economic alliances and trade patterns for years to come. The latest economic data is doing little to quell the uncertainty in the markets. Jobless claims for the week ending April 5th came in at 223,000, slightly higher than expected. While continuing claims fell to 1.85 million, the uptick in initial claims suggests that the labor market might be losing some steam. On the inflation front, there was a glimmer of good news. The Consumer Price Index, CPI, rose by 2.5% in March, down slightly from February's reading. Core CPI, which excludes volatile food and energy prices, inched up by a mere 0.1%. This suggests that inflationary pressures remain largely in check, giving the Federal Reserve some breathing room on interest rates. Section 5. Analysts weigh in uncertainty reigns. Wall Street analysts are divided in their assessment of the current market turmoil. The trading floor is a hive of activity, with traders and analysts alike trying to make sense of the rapid changes. The atmosphere is tense, as everyone is aware that the stakes are incredibly high. Some believe that the recent volatility is simply a healthy correction after an extended bull market. They argue that the market had been overvalued for some time, and this correction is a natural and necessary adjustment. These analysts remain optimistic, suggesting that the fundamentals of the economy are still strong. Others are more cautious, warning that the trade war, slowing global growth and political uncertainty could conspire to derail the economy. They point to the numerous red flags that have appeared in recent months, including declining manufacturing output and reduced consumer spending. These analysts urge caution, suggesting that the market could be in for a rough ride. George Saravelos, a strategist at Deutsche Bank, believes that President Trump is keeping a close eye on the bond market and is prepared to intervene if conditions deteriorate too sharply. Saravelos suggests that the administration is aware of the potential risks and is ready to take action to stabilize the market if necessary. Lin Song, an analyst at ING, argues that both the US and China would prefer to resolve their differences through negotiations, rather than a protracted trade war. She believes that both sides recognize the mutual benefits of a stable economic relationship and are likely to seek a compromise. However, she also cautions that the path to a resolution is likely to be bumpy. The negotiations are complex and there are many factors at play. Song warns that while a resolution is possible, it will require patience and careful diplomacy from both sides. Section 6. Steel takes a hit. US steel slumps on Trump intervention. In company-specific news, shares of US Steel have tumbled by 10% after President Trump expressed his opposition to Nippon Steel's $14 billion bid for the company. Trump's intervention has raised concerns about protectionism and government interference in the free market. This development highlights the challenges faced by companies operating in industries deemed strategically important by the government. It also underscores the unpredictable nature of the current administration's policies, which can create both opportunities and risks for investors. Section 7. Navigating the roller coaster, a long-term perspective. The recent market volatility can be unnerving for even the most seasoned investor. However, it's important to remember that market fluctuations are a normal part of investing. The stock market is a forward-looking mechanism, constantly pricing in future expectations. As those expectations change, so too do stock prices. Rather than panicking in the face of short-term volatility, investors are better served by focusing on their long-term investment goals. By staying disciplined, diversifying their portfolios and seeking professional guidance when needed, investors can weather the storm and come out ahead in the long run. Section 8. The Investor's Dilemma: Fear or Opportunity. The current market environment presents investors with both risks and opportunities. On the one hand, the trade war, slowing global growth and political uncertainty could lead to further market declines. On the other hand, valuations have become more attractive after the recent pullback, potentially creating buying opportunities for discerning investors. Ultimately, the decision of whether to buy, sell, or hold depends on an investor's individual circumstances, risk tolerance, and investment horizon. Those with a long-term perspective and a strong stomach for volatility may view the current market dip as a chance to acquire quality assets at discounted prices. Section 9. Staying ahead of the curve. Information is key. In today's fast-paced and interconnected world, staying informed is more important than ever for investors. By keeping abreast of market trends, economic data, and geopolitical developments, investors can make more informed decisions about their portfolios. Fortunately, there is no shortage of resources available to investors. From financial news websites and investment blogs to professional advisors and market analysts, investors have access to a wealth of information that can help them navigate the complexities of the financial markets. By staying informed and seeking out expert guidance when needed, investors can position themselves for success in any market environment.